Sir, the first thing that I wanted to ask you is, do you think that reaching a milestone like that of rupees 10 crores, is it possible and what can one do to achieve that?
Oh, it is eminently possible. And it is eminently possible, not only possible, it might be a necessity for the very reason that, the longevity is rising. We are unlikely to be, I can think of all the people, most of the people in the previous generation, my parents' generation, they were they're government employees or semi-government employees or quasi-government employees. And they are being supported by the taxpayer.
Totally.
That's being taken care of.
Yeah.
And they are beginning to live longer. We just might end up living longer. The other is that, the possibility of outliving your savings, that situation is so bad, so grim, more so in the absence of the joint family that we have heard of or we have not lived with, but we have seen it happening, the nuclear families. So that is one, it looks unreal, it looks unrealistic. But let me just give you a context to this. About 50, 60 years ago, or no, about 100 years ago, there was this mathematician in UK called Alan Turing.
Yes, yes.
He's the guy who actually decoded those German codes which led to the winning of the war.
He decoded the Enigma, didn't he?
Yeah, and the first thing was, he was actually declared a crazy guy.
Yeah.
Simply because he could imagine, he could visualize a kind of machine which can behave like humans.
Mm-hmm.
And today we see that as a reality.
Yeah.
If you look at what AI is doing, we will have, we are answering, and the principles were actually, the seeds of that were sown then. He's considered to be, that Turing Award is considered to be a Nobel Prize in computing. But if you look at the principle that he decided, he framed, that breaking the question into smallest element, putting it together, and that is very much true for personal finance. If you look at, if you break this 10 crore thing into smaller pieces, interim milestones, and also let me just bring in some degree of realism in this. Everybody came and talked about the numbers and this and asset allocation, whatever, equity returns, even the Sensex return, which I think, which Samir Arora said that half of the stocks in Sensex are unable to beat it. That is the design of the average. Yeah. And if you go by that, even the dumb Sensex, of without the dividends, without reinvesting those dividends, has given a return of about 18% since its invention in 1978. 18% annualized. And if somebody would have invested 50,000 rupees a month, of course 50,000 rupees a month 25 years ago would have been very significant. But assuming that, ignoring all, no step up, nothing, 50,000 rupees a month, done consistently for 25 years, earning 12%, which is 2/3 of the return that Sensex has given without the dividend, will translate into 10 crore. So unfortunately, we don't come across too many 10 crore pati who were investing in Sensex for variety of reasons. There wasn't a Sensex fund available. Mutual funds were not sold the way they are being sold. Mutual funds were not designed. When I started value research, mutual fund was a seasonal phenomenon. Yeah. Once in a while, there will be a fund which will be launched and people will invest. Today, you give a standing instruction to your bank to enable a 10,000 rupee SIP, and it happens seamlessly. Most of the people who end up wealthy are the ones who are not monitoring it every day. The reward of forgetting it, putting it, an ability to automate it. So I think it is eminently possible, and not only possible, I think it is necessary to be embarking on such an ambitious thing, if at all it is ambitious.
But that's now it comes into the realm of possibility, but the problem with my peers and the generation, me included myself, that what the problem is that we are a generation that, of course, lacks patience. And so how can we how can someone like me convince my peers or even myself to start a journey like that? What advice would you give to us to start that journey of discipline and patience and everything?
You guys are too smart. I don't think I have the courage to give you advice. But I would suggest few things. Don't resist your temptation. Try out things.
No, temptations of what? Like what kind of temptation?
I'll tell you the temptations. Okay. The temptation is, crypto can be very exciting. Eating out tomorrow could be very exciting with your friends. So,
Sure.
that is consumption. Third is that, looking at, because, today mutual funds are sold as a story.
Yeah.
A thematic fund, a defense fund, or consumer fund, or this thing, which will look exciting. And it's not all that bad. I would not like it, but it's not all that bad simply because, if you invest in a mutual fund, if you achieve 2-3 goals, which is you are investing regularly, you are diversifying, and you are able to stick around for a couple of years. Even a lousy fund manager can't really hurt you. Because by virtue of that diversification, by virtue of your long-term orientation, you end up being a winner anyway. But my worry will be, and in the initial stages, in somebody who is, anybody who is in your phase of life, my suggestion to them will be do everything but start the habit of, doing 500 rupee, 5,000 rupee, 1,000 rupee, whatever it be. Because the initial stage is actually habit formation.
Okay.
Most people expect magic to happen. Magic is not going to happen anyway. And in fact, if you get very excited about the market, that is what I have learned in the last 30 years, that every time investors get excited about the market, it is an inopportune time to get excited. It turns out to be wrong in hindsight. But it gets extremely difficult to resist that, whether it was 1992, 2001, and things like that.
We would think that we might have learned by now.
No, and there is another thing about money issues and investment, that you don't learn from other people's mistake. You have to lose your own money. So it is important that you lose early, because you lose less. Because if you resist that temptation, you will not learn it, and then you will lose big time when you will have something more significant to lose.
I think that kind of risk is something that my generation would really relate to. Because that, like, the idea of that adrenaline rush, that you have to lose, so it's better to lose early. I guess that would resonate with a lot of people.
Absolutely. And, it is very difficult. How can you actually tell somebody who is in the middle of, a boom, and, seamlessly you are able to open an account at Grow or Zerodha and anything, and you are able to throw your dart and make money by the evening.
Yeah.
And sometimes the money that you make by the evening is more than what you will actually make by working for 30 days at a stretch. And, bearing your boss and whatever, So if that is the temptation, how can you resist it? You have to lose money. And it is important that you lose money at one go. You read that SEBI report that 92% of the people lose money when getting into who participate in F&O. At the same time, all the winning stockbrokers, they make 90% of the money from those people only. And I don't see, I'm part of many of these regulatory discussions and bodies and committees. I can tell you with confidence that none of that report is going to have an impact, because this is so deep-rooted in our psychology. It is so deep-rooted in our, need for excitement and rewarding excitement. Not only that, in India, it is all the more difficult because all other forms of speculation is illegal. And this becomes an interesting one, which actually gets a legitimate framework that, you are doing something intellectually stimulating.
But like, jumping off from that point, this is the age of influencers. This is the age of startups. And there's still people who stick to more traditional methods and they embrace their salaries. So in this digital age, which is very contrarian to the traditional beliefs, do you think that sticking to salaries is advisable, or one should look for shortcuts?
No, it's meant for different things for different people. Shortcuts generally don't work, but for some people it works. And if they are able to convert, a reward of a shortcut taken into a meaningful capital, that's fine, good for them. But the nature of shortcut, reward from shortcut, is of a kind that you believe in the wrong principle. You think that shortcut is possible, and you can be continually, and it could just be luck. So I think, the wisdom says that a sustainable one is the one which is rooted in principle and a method.
Okay, that's a good advice, I think. But what risks one should be aware of while on the road to building a large corpus for their retirement? Because there are always risks.
Yeah.
And some of them I think one should avoid. Some of them, as you said, we can't avoid and we will lose money. But some of the risks one should mitigate.
Yeah, you have to mitigate 4 or 5 risks, and you should be prepared for it. It is more important that, coming with the wrong expectation.
Yeah.
And the biggest thing is that, if you can actually, you don't have to become an automobile engineer when you learn driving. But it is good to know that when you press the accelerator, what happens? More fuel is going, and what's the driving that speed? If you are at a certain speed, if you suddenly apply your brake, what happens? You don't need to really understand how it really works, but what could be the downside? With that in mind, I would say that understanding how things work. I think, most of the people who get attracted to the market, they think of equity as a game.
Okay.
They think of equity as a ticker.
Okay.
They don't think that, when you are buying the stock of a company, there's an underlying company where 100,000 people get up in the morning at 9 o'clock to get to work.
Yeah.
And they're fulfilling the need of a customer or, making a product or a service. And there is much more to it. What happens, when we are guided by the ups and downs and the madness of the market, you think that this is a game. And sometimes you win.
Yeah.
And when you lose, you run away forever. So I think it's very important that, as I was saying, that form your habit in your habit formulation phase, get going in a steady manner for a certain part of it. Play all your games, spend most of the money. Because initial 2-3 years, it is not the scale of money that you do.
Yeah.
It is to understand that what is this beast. Because the way people get started is exactly the way they will be driven out of the market forever, and they will be deprived of it forever. So if you do that, there are 2-3 things to keep in mind.
Yeah.
One is to diversification. It is the holy grail. You can't avoid that. Second is the asset allocation. But don't worry about asset allocation for the first 5 years.
But why is that? Why is that?
Reason is that asset allocation is like building a shock absorber.
Okay.
It is building a safety net. And you have nothing to lose in the initial 5 years.
Yeah, so
while you're accumulating.
The acceleration is not as much as...
You haven't accumulated well enough.
Yeah.
And then you have to figure out that at what stage, as Nilesha was saying, that, that doctor was losing his sleep. And at what stage do you lose your sleep? And it is very difficult to visualize it till you experience it. As I was telling that you have to lose your own money. You will not be, everybody, because I have seen investors' thinking is very malleable.
But is that a good thing? To be malleable for an investor?
It's a very dangerous thing.
Oh.
The reason is that, we change with times.
Okay.
When you are making money on a day-to-day basis, you have this urgency to borrow money to invest in the market, simply because you feel more confident about it. The moment you lose dramatically in a brief period of time, you suddenly realize that your risk tolerance is very low. And you have to really prepare yourself with your groundwork in terms that when investing in equity, it should definitely be invested in gradually, because markets behave, markets turn around when you least expect it. And you tend to act very aggressively when the market is very inopportune, configured in a manner where your returns are coming very easily. It is very difficult to invest money when the market is falling. We are all doing it in self-interest. We are doing it in self-interest because we don't want to lose money. We don't want to really lose money while the market is going up. So when we do it in self-interest, it is very counterintuitive. And the way it works is that unless you are there for 10, 15 years, at least 5 years at the least.
So it's a long game.
It's a long-term game. And initially, if you are able, so worry about asset allocation after 5 years. Make sure you are diversified. And when you invest on your own, when you take an inordinate risk, you better be aware that you are implementing these principles yourself. And first and foremost, the basic principle, which is always true, And it always keeps reminding, you are always reminded of that, that if something is too good to be true,
It
it is,
isn't.
it won't
It
be.
isn't.
So,
And the idea that something is too good to be true, it isn't. That brings me to this trend that a lot of younger generation is not, they are diverting their mind toward mutual funds because they have become aware of the economy, and it's a good thing. But crypto investing still holds the fancy of many people, especially the younger ones. What would you say to them?
I've been a very, very strong disbeliever of crypto, and I've been wrong.
Oh,
And I've been wrong, and I still feel that, I I'm not embarrassed being wrong.
no, but like,
Uh,
did you change your stance?
No, unlikely. I'm old-fashioned, so but I'll tell you why I am wrong, and why I would like you to take a chance with crypto, and why I will
Meanwhile,
never,
while you won't take the chance. With
while I will never take chances.
Okay.
Because as I was telling you, that I'm a great believer of something which is underlying.
Yeah.
When you invest in a company, there is a company.
Yeah.
When you invest in a bond, when you buy the government bond,
Yeah.
or when you lend me the money,
Yeah.
it is written there that I owe it to the lender, this much
Yeah.
this much rupee.
Yeah.
Crypto is something which has been invented by somebody, and it is like gold, that it is somebody else is willing to pay more money for this, but there isn't an underlying, and you can say that that is true for gold as well. But gold has 1,500-year history.
And crypto is a new thing.
This hasn't. Then I have two big worries about crypto, which I think, at some point, hopefully, will come to haunt us. That crypto has turned out to be, if I have to really buy 50,000 rupees worth of mutual fund, the government mandates that I do a KYC.
Yeah.
If I have to send you $1 billion worth of crypto, nothing is needed.
Yeah.
That sounds fishy. And that is why the drug cartels, that is their primary mode of transaction. That's one. Second is that I find it very funny that all the crime that has happened around crypto, where people have disappeared,
Yeah.
has something to do with crypto. Including the biggest entrepreneur. You remember that guy who was getting into jail and he was the fanciest person?
Yes.
I will be worried, when somebody actually runs a business, fails with the business, he gets into bankruptcy, he gets into insolvency, and then we are able to auction his assets. Here, somebody just disappears with, $500 million, $1,000 billion, $1 billion, and then we say that, all right, somebody, formatted his computer. That was even
How
funnier.
convenient
Yeah.
that was.
You heard that Luna thing, where,
Yes.
which had something worth 10 billion worth of outstanding, and he formatted his computer. So it doesn't smell good, but good till it lasts. And we only, will, I don't know, the jury is still out. There is always the last, there's a musical chair.
Yeah.
And it looks too good to be true.
I see. Okay. As you said that we are going to lose money, so obviously there are going to be there's a good risk mitigation there. So how does one balance what they want in the present and the needs in the future? Because it's a big part of it.
One is that, just be little thoughtful about it. Many a times, I find that I have a lot of colleagues who are of your age. And I find that, initial 5-6 months of when you start your career, don't bother. Don't listen to people like us.
That's
Live
very
your-
validating, sir. Thank you so much.
Live your, live your life in terms of gaining new independence and spending it and whatever. But after that, if you get little thoughtful, because when you go to a shop, being little thoughtful actually works brilliantly, because you guys really won't listen to many people, and you have so much resources available. When you go to a shop and when you see an iPhone, and it doesn't tell you that it is worth 1.44 lakh,
Yeah.
when it tells you that it is 4,999 rupees per month, it becomes very tempting.
I
Just
feel
try and
called. I feel
understand.
called out. I feel a little called out.
No, I'm not calling out. I'm just saying that, if you really figure out
Yeah.
that this 1.44 lakh rupees worth, but you are getting tempted by 4,900 rupees every month,
Yeah.
you must find out that whether you have to pay it for next 5 years or 15 years or 8 years or whatever, you will get a sense of it. This magic of compounding.
Yes.
Till you experience it, I don't think, the joy of consumption is way too tempting. So that is why I'm saying that, do it with the joy of turning a small contribution, small saving into a meaningful capital has to be experienced by somebody to really become thoughtful.
Yeah, it's like a slow burn.
No,
happens over time.
it can be done in 18 months. You'll really realize it.
Yeah. Thank you so much, sir, for
Thank
your
you.
time. This was a very, I would say, a very insightful and at the same time, very comforting session.
Thank you.